Hey there guys, and welcome back to Alex Invest. Today the markets are mixed and it's all good, but we're going to do a bit of a different video today, and we're going to look at how a portfolio sort of should or should not be diversified in certain aspects, and there's a lot of people out there, and most people really tell you want to be very diversified, but I have a little bit of a different thought process towards this, and it really depends on how much money you have, and that kind of determines on how diversified you should be, in my opinion. So to look at that, we're going to look at a charcuterie board and see sort of the comparisons there between a portfolio, specifically a stock portfolio, and compare that, or a securities portfolio, and compare it to how one should diversify or not. So just the other week, right, I got my girlfriend to start investing through her TFSA. Finally, I've been trying to get her to start for a little while now, and a lot of my friends recently have started as well. So they were wondering, how many stocks should they put in a portfolio, and for my girlfriend's sake, I told her to buy 3 stocks. She only has about $2,500 invested in the stock market. So when you have a small portfolio with, a little bit of money and not a lot, it can be good sometimes to sort of keep your portfolio to a minimum of stocks which you truly believe in, and then that's going to really, make your portfolio outperform, other portfolios with a lot of stocks, because you're taking on quite a bit more risk, of course, but especially in the market we're in right now, I think this is quite good to do, just because, again, we're in this bull market. We're going to see big gains, and you're not playing with a lot of money, right? So you have that $2,500, let's say, split between 3 stocks. That's what I did for my girlfriend, right? And so you have a bit of diversification, but not so much that it's eating into those profits, right? So when you have a small portfolio like that, I think it's better to kind of stick to a few stocks instead of, having many stocks that'll kind of dilute the gains that you could potentially make there. And a great way to kind of explain how this all works, especially to people who are just starting, is taking a look at this, a charcuterie board, right? And I've used this example in one of my videos before, but it kind of, I think, got a bit lost in translation there. So we're going to go over it again here, right? So this is a charcuterie board, and there's a few things that I don't agree with on this charcuterie board, and that's exactly the same things that I wouldn't agree with in a stock portfolio, and we could look at this in terms of an entire portfolio as well, not just stocks or not just securities, but your other assets as well, including real estate or whatever else you might have in assets, right? But we're going to stick to just a securities portfolio, a stocks portfolio here, right? So here it is, and what we can see here is, we have a variety of cheeses, we have a variety of meats, and we have a few other things in there, and that's exactly what you want with your portfolio as well, a nice variety of different sort of things, different assets, different securities in your portfolio that are a little bit different, right? So you can enjoy each of them. But, this charcuterie board, for example, there's a few things that I don't like on it. Let's take these. I don't know what these are, so let's get rid of those, right? I don't like them, right? So we get rid of them. And, I don't need all these extra, let's say, crackers here. So let's just get rid of these crackers on both sides, right? Let's just say those are gone. Okay, so now we're looking a little bit better here, right? I've gotten rid of some of the things I don't like potentially, and I've made my charcuterie board more set to what I like here, and I've cut it down a bit, right? And now, what we can note about my charcuterie board here as well is, we have sort of different classes of securities. Maybe we have the meats here are sort of our tech space, let's say. And our cheeses are, maybe our clean energy space here. And, here, we'll do a different color. So we've got our clean energy space here, right? What we can see here is I really like this kind of cheese, right? So we have more of this kind of cheese right here in our portfolio than any other sort of cheese on our platter here, because this is the one that's my favorite, right? So let's just say this is F cell, because that's one of my biggest holdings, and it's in and it's in that clean energy sector, right? And then we've got quite just a little bit of cheese right here. So maybe this is my my OPTT right now, because I sold some of that off last week, I think, just to make room for some other things in my portfolio. And I like this cheese a lot less than I like this cheese, right? So it's smaller on my platter. And again, right, that's what you want to do with your portfolio. Your favorite stocks should have the most amount of money allocated to them, and your sort of least favorite stocks, or more risky stocks, but the ones you still like, should have maybe a smaller portion of your portfolio be that, right? So that's kind of how that works, and then we have our, like I said, our different asset classes. Maybe the crackers are, the health sector stocks or something, and then our fruit can again be a different sort of sector. And then we have this sort of nice range, right, of different classes here of assets or securities in different sectors, right? And we can look at that as well in terms of small cap stocks and large cap stocks. Again, you want a little bit of a mix there, right? And now we're getting into when you have a little bit of a bigger portfolio, right? That's when you can really start to diversify a little bit more into, a bunch of different small, medium, large cap stocks, right? So again, within the meats, maybe this right here is a small cap, and this right here is a large cap stock. So again, we see, we can have them both there, and it makes our portfolio better. And again, the large cap in this case, we have more there because we like that better than this one. So now we have kind of our portfolio here that we like, right? And we have our main, bigger things that we like a little bit more. And so we've made them a bigger part of our charcuterie board, and things we might like a little bit less, so we have a smaller portion. And we've taken a few things out, again, because we don't like them. We don't want them in our portfolio. We don't want them on our charcuterie board. Get rid of them, and we're going to take the money that we otherwise would have spent on some of these things that we got rid of, and we can put that money towards some of the things that we potentially like a little bit more on our charcuterie board. So, let's say this, or let's say this right here, we can sort of increase the amount of money allocated to these things. So again, we can see bigger gains from that, right? Or in this case, we can enjoy our charcuterie board a little bit more. And that's kind of the problem we run into, right? Is we have a limited amount of money to sort of work with this charcuterie board, or to work with our portfolio, right? So that can be an issue, right? You have to decide, what do I want and what do I not want? If you had an unlimited amount of money, well then, first of all, you wouldn't need to be invested in stocks. You could also just keep on adding funds and adding funds, which I recommend, if you have a stable income, and you can take even just a couple $100 of that income every month and put it into the stock market, you're going to be happy you did that in the long term. But anyways, you only have a certain amount of cash which you can use to make your charcuterie board here. And unfortunately, I don't have this much money to spend on a charcuterie board. It's just too expensive for me. I only have $10. And this is where, you get to some of these smaller portfolios. So let's say I only have $10. Well, then I can't buy all this with $10. So what do? I choose my all-time favorites of this charcuterie board, and I make myself a charcuterie board which is 100% for me, and I will enjoy it the most. So I'll choose 3 things. I'll choose 1 cheese. I'll choose 1 meat. I'll choose 1 meat, right? And I'll choose 1 Cracker. So now I've only got 3 things on my charcuterie board, but those things are going to make me the happiest, right? Or are going to make me the most money. And so this is kind of what I did with my girlfriend, with her $2,500, for example. We split it up into sort of 3 sectors and just 3 stocks. So what you're doing, right, is you're in these 3 different sectors, and by doing that, you're diversifying, but again, you're not eating into those profits, or you're not eating into, the things you like. You're not sacrificing the things you like for the things maybe that you don't like as much or something, right? So again, you know, when you have these limited funds, it's important to do this, right? So, for my girlfriend, we chose 3 stocks for her. We chose the Very Good Food Company, which is in the plant-based meat sector. We chose Solar.V, which is in the clean energy sector. And we chose Hitty.V, High Tide, right, which is in the marijuana sector. So again, she's diversified in that sense. She's got, a few more riskier investments, yes, but I think they're ones that are going to do well, first of all. And second of all, when you're only investing with $2,500, you're not, again, too worried about what's going to happen with that money. Sure, you want to make money on that, and you likely will, but when you're too diversified and you make money on, a few of these stocks even, then or securities, you're not going to, be happy with that, because the percents are there, but what isn't there is the cash sort of behind that investment, and you're not making a lot of money. You can really take it as an example like this. If you put $1,000 into a stock and it goes up 100%, you have $2,000, right? But if you only put in $2 into a stock, if it goes up 100%, you only have $4, right? So that's why you kind of want to do this, especially with limited funds, is sort of choose only what you like the absolute best, right? And stick with that up until you can afford to kind of add another thing to your charcuterie board, to your portfolio here, right? Say, the next month I'm able to add $500 or $1,000, then, maybe I can add a 4th thing to my charcuterie board, or a 5th. And then what happens is, over time, you kind of develop this entire charcuterie board. It doesn't happen right away, and it doesn't happen overnight, guys. So that's what you got to be aware of. And, I feel like we can see exactly that from my portfolio here, right? I'm in quite a few different asset classes, and quite a few different securities sort of classes here and sectors, but at the same time, I have about 23, 24 solid stocks, which I like, and I hate going above that, because you're not going to see those gains that you want to see anymore from that. And even for me, I like to stick to around 20 to a maximum of 25 stocks in my portfolio at any given time. So that's really what I wanted to share with you guys today, and I hope this time, this video doesn't get lost in translation, because this is really, a good way to look at it, in terms of, how you want to invest your money and how you want to diversify, because everyone always just says, oh, diversify your portfolio, but there's ways to do it correctly and there's ways to do it incorrectly, and in my opinion, this is the way you want to diversify your portfolio, so that, again, you don't eat into those profits, but you still manage to have some nice diversification and a decreased amount of risk. And other than that, I hope you guys have a fantastic day, and I'll see you guys in the next video.